All right, good evening, everybody. Happy Saturday. It is about 8:46 p.m. Eastern Time here in New York City. It is October 22nd, 2022. I hope everybody is having a fantastic weekend so far. It is Saturday. Tomorrow we will be doing our weekly Markets a Look Ahead live stream, where we'll be covering all of the major events that will be happening in the week ahead on Wall Street. And it's going to be a busy week. We have earnings reports from pretty much all the major big companies that matter. You talk about Apple, Microsoft, Alphabet, and more. I think the bulk of the earnings reports will be from the Dow 30, so you could think about 3M, Caterpillar is probably going to be reporting as well. But tonight, I think it's going to be important to sort of take a step back and talk about the Federal Reserve. So if you could believe it, we are going into the last week of October, and that means on November 1st to November 2nd, we are going to be hearing from the Federal Reserve as they are probably going to raise interest rates about 75 basis points. But over the last week, we've been hearing from additional Fed presidents such as San Francisco Fed President Mary Daly. We heard from Cleveland Fed President Loretta Mester, and we also heard from Philadelphia Fed President Patrick Harker. So let's talk about being hawkish, let's talk about being dovish, and then we are going to end the stream with some interesting stock market return data as we talk about how does the market perform during midterm election cycle years. Also, how does the market tend to perform in the 3 months, 6 months, and 12 months after the election cycle has passed. Now, the midterm elections are going to take place on November 8th, 2022. We're not really going to talk about the political aspect of it, but we are going to be talking about how the stock market tends to perform once midterms are all said and done. So that's the recap for the stream. Let me see who we have in the chat. I'm going to put my laptop away, and we will be walking to the west side of Manhattan tonight. So I see Sunshine After Rain is here. Good to see you. As Spillin is here. Says hello, Tom. Matt S says, yo, Tom, good to see you. Buy the book, welcome. Austin City Limits, British Gray is joining us. I see Jonathan A, Paul Greenwell, MSK, Gary Carpenter, Charlie Richardson, Patty, Rocket. I see Mary, I see Google, Latha. Hopefully you guys are enjoying this view. We are at the WeWork on Madison Avenue and 31st Street. It's a beautiful night. And let's get started on the stream. I see Deborah is here. This is Andre Almar. Welcome. Lee, the one and only Dusty Cole. Good to see everybody. It should be a nice night. Let me just close this window. I'm going to put my laptop away and we will get started. So I'll put you guys down. And we'll get started. All right, we are good. Hopefully everybody's having a good Saturday. I had a pretty good Saturday myself. Took some time to sleep in, much needed sleep. Horatio Snipes says the Yankees lost 5-0. Were the Yankees playing tonight? I didn't even know that. Iceman, good to see you. All right, team, I'll meet you on the other side. Hopefully we don't have any internet issues. Let's see. All right, hopefully we didn't buffer. You know, out of curiosity, everybody, did we buffer when we went into the elevator? Just out of curiosity. Back on the ground floor, ladies and gentlemen. This is the beautiful Madison Avenue. This is East 32nd Street in between East 31st. Hey, Alfred is here. Says, love the streams, Tom. Thank you so much. Oh, we buffered a little bit. It's okay. No big deal. Destructionist. Good to see you. So one of the things I wanted to talk about on tonight's live stream, and for those of you who have been tuning in to Walks in Wall Street for quite some time now, you know that usually Monday through Friday is dedicated to a specific financial topic. Saturdays, we usually just walk around the city, have a good time, and Sundays are our Markets a Look Ahead live stream where we cover all of the, I would say, the main events on Wall Street for the next week as it relates to corporate earnings, major market announcements from the Fed in relation to the FOMC meetings, and key economic news. But tonight I want to do something a little bit different. Now, October is almost behind us, as crazy as that may sound. And I think we are entering into one of the most critical times in market history, because this is the midterm election season. And on November 8th, 2022, that's when everybody's going to go to the polling booths and cast their votes. Now, we're not going to talk about the political aspect of things. What I think would be interesting and fun is to talk about how the market tends to perform once the midterms are in the rearview mirror, I should say. Because midterm elections, or I would say the point leading up to midterms, can bring about a lot of uncertainty. And there's one thing that the market hates more than anything, and that's uncertainty. And I think we could all agree with that. So once this uncertainty is behind us, how does the market perform? We'll figure that out tonight. RJ is here, says, yo, good to see you, RJ. Beltrix RL says, how was work today? It wasn't too bad. I took the day off. I slept in until after 12. So it was good. It was good. Another thing we're going to be touching base on is the Federal Reserve, because not next week, but the week after, we are actually going to be hearing from the Fed at their next meeting. And consensus shows that they're probably going to be raising interest rates again by 75 basis points, okay? And this is absolutely critical to pay attention to, because if they do indeed raise rates by 75 basis points, that would be the fourth consecutive time of a 75 basis point raise. Now, for some context here, up until June, so June was the first month that the Fed started to, I would say, decide to raise rates in increments of 75 basis points. That was the first time that they did that since 1994. So before I was born. So I wasn't even alive, was the last time the Fed started to raise rates aggressively by 75 basis points. And I think this is why we always review on the channel. We have reached what I like to call a new paradigm. Very similar to the 1980s. We talk about Fed Chairperson Paul Volcker. Jessica B says, hey Tom, good to see you. Welcome, Jessica, always a pleasure. Laytha says, interest rates are already the highest they've been in 22 years. Yeah, I mean, we are sort of undoing ZERP, pretty much. Kevin Ramsey says, hello everybody, good to see you. Kevin. Brian says, hello Tom, and happy Saturday. Hopefully you guys have some good plans for the weekend. Check out the architecture on this building here. Really, really nice. You know, I think we're gonna walk all the way down to the West Village. We usually don't get a chance to go to the West Village, so I think it'll be interesting to go there tonight. Hey, Julia M says, hola Tom and fam, good to see you. Julia, Destructionist, I trust you're doing well. Austin City Limits, Florida. So it should take us probably about 30 minutes to get there. But being that it's a Saturday night, it's probably going to be really, really busy. So usually the east side, or I would say the lower east side, and also like Greenwich Village area, tends to be very, very busy on the weekends. Hey, somebody says hello from Athens, Greece. Have a good night in New York City. Well, good to see everybody from Greece. Welcome, everybody. Stacy Sills says hello. Hope everybody's having a good Saturday. I am having a good one. That bike almost got killed. Did you guys see that? That biker almost got obliterated there on the turn. That wasn't good. Says, been enjoying the streams. More of a crypto guy, but love hearing you talk about the market dynamics. Yeah, well, I mean, I think that, well, first of all, thank you for watching. Second of all, I think if you are a crypto guy, right, I would say nothing more sort of impacts the movement in cryptocurrency prices than the NASDAQ, right? So we've seen a very, very high correlation between Bitcoin's price movement and the NASDAQ. So I do have exposure to Bitcoin myself. The other alternative coins, I'd say a lot of the altcoins I tend to stay away from, mainly because we just do not yet have regulatory clarity from Gary Gensler and the SEC. So I tend to sort of take a back seat on that. But we have a very, very close correlation here. You could pretty much almost guarantee if the NASDAQ is down, Bitcoin will be down and vice versa. Now, we're seeing a very interesting thing in the price of Bitcoin. And I've tweeted about this. If you guys want to follow me on Twitter, you could follow @WalksWallStreet. And one of the things that I'm noticing as it relates to the price action of Bitcoin is we're experiencing a period of volatility contraction. So if you look at a 50-day moving average on Bitcoin, it seems like price is tucking in and hugging that 50-day line, although under the 50-day moving average, and its average daily range is contracted significantly. And this reminds me of 2018. Now, does anybody remember the price action of Bitcoin in 2018? I would say the latter half of 2018. And we saw something very, very similar. And this was after this huge drawdown we had coming off of the very speculative crypto mania of 2017. And we sort of consolidated in a range. And I remember the big joke was that, you know, one of the reasons why people don't like Bitcoin is because of all the volatility. So during that time period in 2018, people were posting memes and going on CNBC and saying, well, look, the volatility has been contracting, so I guess that's not an argument anymore. And then the price of Bitcoin blew wide open, and we sold off very, very aggressively. And I think we may do the same thing. We may do the same thing here. Also, some very interesting things going about with miners right now. I'm hearing some sort of whispers on the street. A couple big crypto miners may be in trouble here, but that's all speculation. Deep Value Alex, what's up? Good to see you, my friend. Happy Saturday. Savi is here. This is a very good evening, Tom and everybody. Good to see you, Savi. Trust you're well. Latha, Gary Carpenter. Linda Silva says good evening all. Prince Ice says good evening. UniJ22. Tiago Pereira says good evening, Tom. Thanks for being here. Yeah, Julie, you saw that guy, that biker guy almost get hit? That was insane. So we're here at Madison Square Park, where we're gonna be walking down. I think we're gonna see a really nice view of the Empire State Building here in a minute. But let's check out sort of West Village, Greenwich Village area. Hey, Largo is here. It says, good evening, everybody. Thank you for the stream, Tom. Thank you so much for being here. I appreciate it. Austin City Limits says it's computerized money. Indeed it is. So there was an interesting article today in the Wall Street Journal that did a pretty good breakdown of all of the, I would say, the sentiment of a lot of the Fed presidents. Now, I think a lot of our conversation as it relates to the Federal Reserve, we always talk about Fed Chairman Jerome Powell as the main Fed chair. However, very seldom, I wouldn't say very seldom, but a lot less often, we talk about the Fed president. So over the last week, they've been floating out a lot of additional Fed presidents, I should say. Now, granted, we're going to be talking about a specific three. Number one being the San Francisco Fed president, Mary Daly. And she has been historically known to be quite dovish. Now, if anybody doesn't know the terminology there, dovish tends to refer to the fact that the particular Fed president prefers a little bit of a looser monetary policy, and a hawkish Fed president, or hawkish, tends to prefer a more, I would say, tighter form of monetary policy, which would mean, continuing to raise interest rates or holding interest rates high, as well as unwinding that balance sheet. A lot of times when we're talking about quantitative easing, we talk about the expansion of the Fed balance sheet. And the Fed balance sheet, you could actually look in real time. It's made up of mostly mortgage-backed securities and U.S. Treasuries. But the San Francisco Fed president, Mary Daly, came out, I believe on Thursday, and said, and I quote, "This is the time now to start planning for a stepping," I think her exact words were, a stepping down or a ratcheting down as it relates to the Fed funds rate. So at their next meeting, we should be getting a 75 basis point rate increase, but Fed presidents such as Mary Daly think that we should do a 50 basis point rate hike, and then in December, do no rate hike at all. And the argument there is that we've been very aggressive with raising rates, but we're not going to see the material impacts of those rate hikes for another couple quarters. And I think generally I may agree with her, but I would much rather get a lot of these rate hikes out of the way, get us up to a more, I would say, normalized interest rate environment, because a lot of the problems, a lot of this inflationary mess that has occurred here in the United States, with the CPI running above 8%, right? Multi-decade highs as it relates to inflation, I think it has to do with all of this endless money printing and over a decade of quantitative easing and artificially low interest rates. So I don't know. I don't think there's going to be a Fed pivot. I think we're going to get a 75 basis point rate hike at the November 1st through 2nd meeting. And I think we're going to get another one, 75 basis points, in December. And that's probably going to take the Fed funds target rate to about 4.25% by the end of this year. That's sort of where I hold firm on. But what do you guys think? Love to know your thoughts. Sinjib is here, says, "Hey Tom, how are you?" Good to see you, Sinjib. I'm doing very well myself. We are standing at the 23rd Street station. You can get the RW trains right outside Madison Square Park. We're gonna cross the street here. I'm gonna give you guys a good shot of the Empire State Building. Hey, Marcelo Gill says, "Hey Tom, great Saturday night stream. Good to see you." Marcelo is joining us from Brazil. Welcome, Marcelo. Laytha says, "Tom, we have enjoyed extremely low interest rates for a long time. Yeah, and I think we're unwinding a lot of that now." Wow, the Empire State Building has no real color scheme tonight. It's just lit up in the classic white. It still looks pretty good. Hey, Jennifer is here. This is New York City. I love it. Good to see you, Jennifer. Hey, War Walker. Thanks for joining us. Beltrix says, "What do you think of Brazil?" Love Brazil. Long Island Ducks, but since there's so many people. Jerome H. Powell says, "Did you call me?" We did call you. Good to see you, Jerome Powell. Freddie Fred says, "Hello, everybody." Welcome. Iceman says, "Tom, do you think about..." I don't think that. Pilot says there was an article in Market Watch that said mortgage rates could go to 10% in Q1 of 2023. What are your thoughts? So I think it's possible. However, let's talk about interest rates for a minute. I actually do think we've seen a short-term top in rates. So if you have TradingView, if you go to like a tradingview.com or something like that, what I want everybody to do is pull up a chart of the 10-year US Treasury yield. Now, not the bond. You could pull up a chart of the yield, and you'll sort of see what I'm talking about here. Moving average, or a 50-day moving average on the 10-year US Treasury yield. We're extended above the 50-day by over 10%. So there's a couple things in play here. If we get a pullback in the dollar, right, because the dollar, or the Dixie, which measures the strength of the US dollar against a basket of currencies. If we get a pullback in the dollar and yields come down, now I'm not saying this is going to be a full-time top in yields. I think it's going to be a temporary top in yields. Well, then I think we can get a pretty sustained, although short-term, I would say, rally across the board in the equities markets. So if you think about the S&P 500, the NASDAQ and the Dow Jones Industrial Average, and that would actually coincide with historical trends. And I'll tell you what I'm talking about in a minute. I just want to give you guys one more shot of the Empire State Building here as we just crossed West 22nd Street. Look at all the traffic piling up here. Tons of traffic piling up. Because we're in a very interesting, I would say, dichotomy right now. So let's just talk about some data, and maybe that'll help us, answer our question. So September is by and large the worst month for stock market performance, without a doubt. So the worst month for stock market returns as it relates to the broader based indices is September. However, if we think about October, November, and December, if we look all the way back to price history starting in 1928, the S&P 500 has gained about 0.5%, 0.6%, and 1.4% respectively in October, November, and December. Now, December has gained about 1.4%, mainly because of window dressing and something that I like to call a Santa Claus rally. And I think this year may be no different. And the reason why I'm saying that is because this year is very, very unique due to the fact that it is a midterm election cycle. So we are going to have midterms in early November. That is going to be out of the way. And if we look at historical stock market returns during a midterm election year, and 3 months, 6 months, and 12 months after the midterms, stock market performance is unanimously positive, actually very, very strong. So if we have a short-term top in rates, if we have a short-term top in the dollar, and we have historically elevated negative sentiment across the board in the market.
Fuck you! Shut the fuck up!
Hold on, let's just let this derelict go by. In the market, then I think that I think we could have an exceptional rally towards year end. Hey, KB says, hey Tom, can you give a shout out to my family? We all watch you. Welcome. Vivian, thank you so much. Thank you for watching. Hope you are enjoying the beautiful night in New York City on the corner of East 20th Street. Hey, Western Mass Dave, good to see you. Hey, Scott says, Tom, do you watch the All In podcast with Chamath Palihapitiya? Insightful private and public tech market analysis. Yeah, I watch it sometimes. I've seen it. It's very good. Very, very good. Now, the one thing I don't appreciate about Chamath, just in all honesty and in full transparency, is that Chamath was really pumping all of these SPACs, these special purpose acquisition companies, which, you know, allegedly, I can't say for sure, but I mean, he knew these things were nonsense, in my view. Now, here's the problem with a lot of those special purpose acquisition companies, or SPACs. A lot of the financial forecasting they gave, just from my experience, I don't think the management actually believed that they could hit those metrics. So for example, all of the revenue estimates and earnings estimates of those companies that they gave to investors, it was all a huge pipe dream. And if you look at the data now, about a year after all of that SPAC mania nonsense, I think less than 2% of all the SPACs that went public actually even came close to hitting their financial forecasts. And a lot of them are out of business. A lot of them have gone to zero. Al Baker, what's up? Mona D is here. Welcome, welcome. Jeff W277 says, okay, 2018 didn't rally in December. Yeah, I mean, the stock market actually bottomed on December 24th in 2018. So I think the day of the bottom of the stock market was Christmas Eve. I remember I was trading it, and I remember the fear was so high. The fear was so high on Christmas Eve in 2018. I even had my brother text me about the market. And usually when family members start to text me, or my friends start to text me or call me about the market, it's pretty close to a bottom. But yeah, 2018 was a wild year, and usually that's how markets bottom, right? So if you look at the price action of the S&P historically, the S&P loves to make these big V-shaped market bottoms. Look at 2008, 2018, 2020. It's a good point. Hey, Gaston Sales is here. Says, hey, Tom, good to see you. Thank you for joining. Carl says, I still own Virgin Galactic. Yeah, that's another one of, who was that with? I think that was Richard Branson and Chamath. Austin City Limits is, Tom, I hope there'll be a rally right after midterms. Mr. Farva 85 says, Tom, what are your thoughts on Carl Icahn? I really enjoy Carl Icahn. I think he's a very bombastic character. Very big personality, New Yorker. I think he's in Florida now. Now, I'll tell you a quick story about Carl Icahn. This is my favorite Carl Icahn story of all time. And I actually think this is pretty appropriate to sort of talk about this Carl Icahn story right now after some Twitter news we just heard from. But before we do that, just for some context, this is East 17th Street, and you have a beautiful view of the Empire State Building looking northbound. Now, speaking of leverage buyout deals, or LBOs, a lot of these banks, I've been noticing, that have been financing the Twitter deal, like Bank of America, I think Morgan Stanley. Now, they're choosing to keep a lot of this debt on their balance sheet as opposed to selling off the debt to investors, right? Because think about the valuations that they did this Twitter deal at. So if you were to sell that debt to investors, like hedge funds, things like that, you'd probably be selling it at pennies on the dollar. So I think these banks are going to hold that debt on their own balance sheet. And I think it's going to be interesting to see how that plays out, because we're coming up on a lot of the bank stress tests going into the end of the year. Anyway, I think we'll do a completely different stream about that. But I want everybody to take a look at this YouTube video, because Elon Musk came out and said that he's probably, again, this may be a rumor, it may not be, but it was a big headline on Bloomberg. And he said he may lay off about 75% of the entire staff at Twitter. Did anybody see that headline? Did anybody see the headline that Elon Musk said he's can lay off about 75% of the workforce at Twitter? So the way that sort of ties into Carl Icahn is way back in the day when Carl Icahn bought this railroad company. He walked into the office building in Manhattan, like one of these buildings, maybe not one of these in Midtown. And he said, I couldn't figure out what half these people do. He's like, I'm walking around, I'm talking to the management. He's like, I can't figure out what any of these freaking people do. So I hire a consultant. Consultant says, you got to pay me $250,000. Carl Icahn's like, all right, boom, 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 $250,000. Tell me what these people do. A couple months go by, and the consultants say, Mr. Icahn, you know, you've been very straight with us. You've been very respectful up front. We want to do the same thing to you. He's like, we can't figure out what these people do. And on that day, Carl Icahn fired every single employee at the company that worked in Manhattan, floors of people, and nothing ever came about it. Nobody called, nobody sent any emails about it. It was almost like these people didn't do anything at the company. And if anybody types in Carl Icahn, mass layoffs into their YouTube browser, you could actually watch the interview where he was talking about it with Andrew Ross Sorkin. It was a wild interview. And so that sort of reminds me of what Elon Musk may do or allegedly do with Twitter. So this is the New School. This is a very, very famous design school here in Manhattan. It's one of the best around. And if we continue to walk down this road, we are going to slam right into NYU, New York University. And if you look all the way at the back of your screen, or the back of the, I guess you can call it the stream here, you'll see the One World Trade Center in the background. Really nice night. A lot of people out. Hey, War Walker, says Tom, he tried that same nonsense with TWA when he ran back in the day. Yeah, I think I heard about that too. Yeah, Deborah says that's the I fired 12 floors worth of people story. Crazy, right? Just a crazy, crazy story. Hey, Israel's here. Happy Saturday. Thank you so much. Hey, SD Rob says, was this inspiration for a Wall Street Gordon Gekko speech to shareholders? I'm not sure. Could have been. Could have been. Hey, D is joining us in the chat. Good to see you, D. Chris Beeman is here. Chris, please feel better, my friend. Please feel better. I know you said in the chat you're not feeling well, so please feel better. You know, it's strange. Now, let me know if anybody else is experiencing the same thing, because I wouldn't say I was sick. I think I was just a little bit run down for the past week. But a lot of my clients and a lot of, you know, people that I work with, it seems like every other person I know is either sick or they have a little bit of a cold. So please make sure you increase that vitamin C intake. It seems like something's going around. Hey, Rockets is Tom. He is taking it private after the potential purchase, so it may be a good idea to cut back. Yeah, I mean, Rocket, that's a good point. So here's what I'll say. I'll make a quick comment, and let me know if you guys agree, disagree. Maybe you see the same thing in your general life, but I think right now, especially at a lot of these tech companies that were allowed to get extremely bloated, right? And I'm going to use a couple companies as an example. Maybe we'll talk about like a Peloton and a Zoom. A lot of these stocks that went crazy, or companies that went crazy during COVID, you know, they were able to sell a lot of stock to investors to then expand the business, hire more employees.
People who are not smart, I don't know.
And the problem with that is when companies grow too fast, too quickly, a lot of random shrieking on the channel tonight. I think we saw like 3 or 4 people randomly shrieking at once. A lot of these tech companies, a lot of the jobs, I'm trying to say this in the nicest way possible. There's a lot of duplicity. Does that make sense in the organization? So I think a lot of these companies, and again, this is my opinion, I think they could probably function just fine with about 25% headcount reduction across the board. Now, this isn't only me saying this. This is actually Mark Zuckerberg, the CEO of Meta, as they're going through a big restructuring. I think Alphabet, Google is doing something similar with their restructuring, and there's a lot of duplicity within the organization. So I think as we go into this economic downturn, I think you're going to continue to see, as I like to call it, trimming the fat in these organizations. Austin City Limits, good to see you. Hey, the usual suspect is here. Welcome. Hey, Y-Town is here. It says, greetings from Youngstown, Ohio. The Brooklyn Bridge Park Carousel originally was located at an old amusement park in Youngstown known as Adora Park. Was it really? I never knew that. Thank you for sharing that with us. Really interesting. Man, we should stream down there one day. We haven't been down there in a couple months. Yeah, so Latha's, like, I think you mean redundancy. Yes. That is what I mean. Thank you for that. Latha says Elon Musk paid too much for Twitter and now people are going to pay for his poor impulsive buy. Yeah, well, he definitely didn't time that. Definitely didn't time that market buy too well. Now, I mean, I think it's the fault of the banks too. I mean, you know, somebody had to give them the money to do it. And as interest rates have gone up, you know, if you just look at leverage buyouts in general across the board, a lot of these banks took a bath on a lot of these bad, I would say, a lot of these bad loans, I would say. Right? Is anybody familiar with the Citrix deal? I think that was multi-billions of dollars worth of losses on the Citrix deal. And that's why right now, a lot of these banks are choosing, well, I think they are going to choose to hold a lot of this debt on their balance sheet instead of sell it off. Because if they sell it now, they're gonna have to take massive losses on this stuff. Yeah, Zay Batana, that's a good point. Because a lot of the redundant people are the ones that are in the positions to make those firing decisions. That's funny. Hey, Robert is here. Freezer, welcome. Good to see you. So I'll ask you guys, you know, now that we were sort of talking about what a lot of these Fed presidents have been saying, for the next Fed meeting that's going to happen November 1st, November 2nd, what do you guys think? You guys think we're going to see a 75 basis point rate hike? You think the Fed's going to tone it down to a 50 basis point rate hike? And where do you think we're going to end the end of the year as it relates to the Fed funds rate? I'd be interested to see what the consensus is on the chat. All right, so we are coming up on New York University. Cindy Foley is here, says, hey, good to see you, Cindy. The one and only NNB 045 says, hey, Tom, my employer uses Citrix as their remote work platform. Ah, very nice. So Harry Connor says 75. Roberts says 75 basis point rate hike. Western Mass Dave says 75. Austin City Limits is, I hope, for a 50 basis point. Jeff says 75 and then 50. Al Baker says 50, then 25. Interesting answers here. Interesting answers. So I'll give you my answer. I think they're going to do back-to-back 75 basis point rate hikes. And I'll sort of give my reasoning why. Now, did anybody see what Philadelphia Fed President Patrick Harker said last week?
I realize what's happening.
And if you didn't hear what he said, I'll read you one of the very key notable statements that he made during his speech. And he says, and I quote, given our frankly disappointing lack of progress on curtailing inflation, I expect to be well over 4% as it relates, he's talking about the Fed funds rate, by the end of the year. So based upon that, where do we think the Fed funds rate is today? Well, it's at 3.25%.
it's like
to 3 point. I mean, it's at 3% to 3.25%. So if we get an additional 75 basis point rate hike, well, that's to 4%. So it seems as if the vast majority of Fed presidents are rather hawkish, and there's a select few Fed presidents, such as the San Francisco Fed president, Mary Daly, that are very dovish. Now, the market really rallied on Friday after Daly's speech, but she's always been dovish. I think in order for a real sustained pivot to happen, and this is the front of Washington Square Park, I think for a real sustained Fed pivot to happen, what's going to need to happen is some of those more hawkish Fed presidents to start to flip more dovish, right? Because a lot of the times you'll see in Bloomberg, CNBC, they just say, oh, Fed president is very dovish, made these dovish statements. But at the end of the day, they've always been making these dovish statements. So consensus is that for the vast majority of Fed presidents, if you think about the Philly Fed president, and if you also think about Cleveland Fed president Loretta Mester, they are extreme hawks. And I think they are going to have more, I would say, influence on Fed Chair Jerome Powell's ultimate decision. And I think that decision is going to be a 75 basis point rate hike. Yeah, the arch is awesome. I do agree. I'll try to give you guys a close-up shot so you can see in more detail the arch here. Now, there's actually a lot of pretty good and talented skateboarders here too. It's Washington Square Park. But check out the detail on this arch. Extreme detail. Absolutely beautiful. Hey, Noel A is here. Says, hey everybody, good to see you, Noel. Thanks for joining. We are in Washington Square Park tonight. Check out this dog here. 10 out of 10 on the dog. Hey, SoCal Lawrence, thank you so much for the $2 donation. You're very kind. I appreciate you, SoCal Lawrence. You know, one thing I've noticed over the years here is that they've actually been cleaning up Washington Square Park a lot. It's actually pretty nice. When I used to come here, even just a couple months ago, it was really, really dirty, but it seems pretty nice. It seems really nice tonight. All right, so we are going to leave or exit Washington Square Park on the south side of the park. But before we do that, I want to show you guys the view of One World Trade Center. Hey, GX72 is joining us. Good to see you. Sunshine After Rain is here. Welcome. Now they have the fountain up, but I think they're probably going to close this down in maybe a couple weeks, depending on the weather. Hey, Y-Town says, hey Tom, I have a question for you. On a scale of 1 to 5, 1 being the worst, 5 being strong, where do you see the economy in the mid to late 2023 in the U.S. as a result of inflation and GDP issues? Well, I think next week we are going to get the official GDP result out, aren't we? Does anybody know what the consensus is for, or I would say estimate, for the GDP reading that's going to come out next week? What is it, 2.5%? Could somebody look that up really quick, actually? Because I think that's pretty important. I was reading about it. I forgot to put it in my notes. But I think we're going to get the GDP number out next week. So where do I see the economy? I see the economy getting worse before it gets better, but I see the market potentially recovering, because the market usually recovers before the economy, and the market is usually a leading indicator. So I think if all plays out well, once we roll through midterms, which should be after November, first, second week in November, if history tells us the truth, we should have a pretty nice stock market rally. But in terms of the economy, I think the unemployment rate is probably going to tick up, which is something that the Federal Reserve actually wants to see. Now, 2 weeks ago, we got the jobs numbers, or the jobs report, I would say the non-farm payrolls. And non-farm payrolls were disastrous, but the unemployment rate actually came down, which is not good if you are talking about a Fed pivot, because the unemployment rate was 3.7%. Then we actually went down to 3.5%. And the market sold off pretty harshly, because one of the things that the Fed wants to see is the unemployment rate tick up. Because if the unemployment rate ticks up, that's probably going to ease a little bit of wage inflation. And wage inflation has been running hot in the United States. This is a good coffee shop, by the way. West 3rd Street in Thompson. It's called Irving Farm. It's a very good place. And one of the reasons, I would say, one of the reasons why wage inflation has been really, really running hot is because the job market has been running white hot, for a lack of a better term. And I believe there's about 2 job openings for every 1 person looking for work in the United States. So if your talent pool is extremely, extremely small, and maybe, like, let's say for me, for instance, if I'm interviewing at 2 to 3 different companies and I get an offer from 2 of those companies, you know, now I could pin those offers against each other to try to squeeze a higher salary or a higher compensation out of those particular employers. So that has caused wage inflation. So I think as the unemployment rate ticks up, as layoffs really roll through, I think the economic conditions are going to get worse in the United States, but I think that is the moment in time where we are going to see the market in general probably turn around and start to pick up. But what do you think? I'd love to see your perspective, or hear your perspective on that. Now check out this ramen shop here. This is sort of like the NYU college town. Very nice area, very fun. Al Baker says, do you think the rally depends on the result of the election? Yes and no. And I know that's a horrible answer, but I'm sort of going to explain my answer. If you look at the results, what would be the most favorable result? Now, the most favorable result, if you look throughout history, for the market would be, number 1, a Democrat as a president, and number 2, Republican controlling both houses of Congress. Oh, this is a really cool store. I want to show you guys real quick. These are all chess sets. So historically, we could potentially be coming up on the most favorable market environment as it relates to equity returns. And that is a Democrat as a president. We have Joe Biden. And if we have, what are they calling it? Are they calling it a red wave? If we do have the red wave, and the Republicans take control and we have Joe Biden as a president, I think the market is going to rip. And that's not my opinion. That's just based on statistics. That is the most favorable market environment, is when we have a Democrat as a president and both houses of Congress are controlled by Republicans, mainly because the market doesn't really like any uncertainty, and the market likes gridlock, right? They don't like government working together. They like a dysfunctional government. So, but we'll get into some specifics about what the market tends to perform after the midterms. Yeah, Billy's is very cool. I love chess. I do too. Yeah, it's not very often you see an actual store that's dedicated to chess. A lot of very unique things here, but good to see you, Billy. Sonia C is here, says, hey Tom, where you headed tonight? So we are gonna head down to Greenwich Village, the West Village. But right now we are walking through, I guess I could call it the college town area of NYU, which is also one of my, I guess, more favorite places in the city. But good to see you, Sonia. But if you guys are enjoying the live stream so far, feel free to leave a like on the video and hit the subscribe button if you're new. We do these live streams about 5 days a week between New York City and Miami, and we'd love to have you guys along for the ride. A lot of traffic down here, isn't it? Jeff says, I get calls from Indian tech recruiters 5+ times an hour without actually submitting my resume to jobs on job boards. I'm not getting calls because I'm a great programmer. Now, I don't really get calls. I get those LinkedIn messages. Does anybody get those LinkedIn solicitations from like recruiters? I get a lot of those, but not really for developer positions, mostly for sales positions. Tech sales, I guess. Hey, Al Baker, good to see you, Al. So this is one of these outdoor dining places that are actually pretty nice. Wayne McKay says, Tom, real gross domestic product, first estimate, Q3, 2.4% on Thursday. Okay. Yeah, so Wayne, what do you think? Do you think that that estimate is going to be a little high? Or do you think that estimate is a little low? Okay. Andre Almar, this is a moderator, put me in timeout. Maybe it was the Nightbot. Usually the Nightbot accidentally times people out. Wow, Wayne McKay says you think the estimate is going to be a little low. Okay. Laura M says, hey Tom, nice to see New York City lively again. Likewise, Laura, hopefully you're having a fantastic weekend so far. So let's actually dive into some of the statistics to see just how the market tends to perform after midterm elections. And I think this is going to be pretty interesting to talk about because it seems as if for the past week on the live stream, we've been really covering a lot of negative, I would say, core concepts. But that's mainly because we've been getting a lot of negative economic news, right? We heard from the National Association of Realtors, existing home sales have plummeted. Mortgage demand or mortgage loan demand is at an all-time record low, obviously due to the massive move in interest rates we've had. I believe the average rate on the 30-year fixed rate mortgage is 7%. So that's really been putting a hammer on demand for housing. But here's some good news. You guys want to know the good news? Here's the good news. So historically, September is the worst month for stocks. But in October, November, and December, going back to 1928, the stock market usually returns about 0.5% in October, 0.6% in November, and 1.4% in December. So that's the good news. And usually the market tends to rally a little bit more in December due to window dressing on Wall Street and what they like to call the Santa Claus rally. But if we take it a step further and look at midterm performance or midterm election performance. In the 20 midterm election years since in that same time period, 1928, the S&P 500 gained an average of 7.6% in the 3 months after the midterms. So 7.6% rally in the S&P 3 months after the midterm elections. If we take that out an additional 6 months, the S&P 500 tends to put on a percentage gain of about 14%. And 12 months or a year after midterms, so you could say this time next year, the S&P is usually up almost 15%. So that's the good news. So once midterms roll around, and we're pretty much trading at the lows across the board in the NASDAQ, the S&P, and the Dow, we could be setting ourselves up for a rally if history repeats itself. Hey, Al Baker says, Tom, I just don't understand how people can afford taxes and insurance on a house in Florida. Very insane.
Shut the fuck up. Shut the fuck up. What country are you in right now? Shut the fuck up.
Oh, God.
Shut the fuck up. What country?
Gee.
Where are you right now? Call 911. What country are you in right now?
See, this is the problem with New York. There's so many nuts, man.
911, dickhead. Fuck are you from? Causing traffic, dickhead.
Jeez. Hey, Mike Skate TV, what's up? Andre Almar says, what is the best state tax-wise? Tax-wise, in terms of state income tax? Well, I know Florida doesn't have state income tax. So let's say if you work in Florida, here in New York, we have to pay state taxes, we have to pay city taxes. So if you work in Florida, you don't pay any state income tax, which is a plus. So what states in the United States do not have state taxes? I think it's Florida, Wyoming, Nebraska. Yeah, so Andre says Wyoming has no personal business taxes. SME Media says Texas, that's right. Well, SME Media, here's the interesting thing about Texas. So it seems as if a lot of people have been moving to Texas, but here's the issue. They have very, very high property taxes, like really, really aggressively high property taxes. And I think a lot of people don't take that into consideration when they move there. And I think people are gonna get big sticker shock, especially if you just bought a home within the last year. You know, once your appraisal rates go up, I think you're gonna get a big tax bill. Okay, so Rick K says Nevada. Andrea says South Dakota, Nevada, New Hampshire, Texas also don't have state income taxes. New Hampshire, that's right. Live free or die. Love New Hampshire. Hey, Dan Zhang is here. Says, hey Tom, how's your Saturday? Saturday's going good. I took the majority of the day to sleep, honestly. I slept for quite a while. And I feel good. What about you, Dan? Feeling good. All right, so what are the probabilities that that stock market rally persists? Okay, what are the probabilities here? So we just reviewed that in the 20 midterm election years that have occurred during that time period, so since 1928, the S&P 500 has averaged a 7.6% gain in the 3 months following the midterm election. Now, the S&P has also gained about 14% 6 months after the election and about 15% an entire year after the election. So what are some of the probabilities that that'll actually materialize and happen? Well, I'll tell you. So in all of the post-midterm election timeframes over almost 100 years, only 3 times were those market returns negative. So only 3 times. So, I mean, I wouldn't say I'm a math genius, but do you think it would be wise to bet against the market going up against those type of statistics? Now, I don't know. I mean, we did just get a follow-through day on Friday. The S&P 500 on its 5th rally day attempt closed higher than the previous day's close on higher than normal volume. Abby 1, good to see you. Hey, Action Kid is here. What's up, dude? Says Alaska doesn't have state income taxes either. Is anybody in the chat from Alaska? I don't know if I could do it. Willie says it's different this time. Famous last words on Wall Street for sure. I don't know. And look, I try to keep an open mind because right now this market has every reason to go down, right? I think we could all agree on that. This market has every reason to blow wide open and go down. But it seems to be holding strong. It seems to be holding strong. We did get a follow-through day. We're coming up on midterm elections, and consensus is very, very bearish. Consensus is extremely negative. So we'll see. We'll see. Hey, George is here. Good to see you. Dan Zhang says you can bet against the market if it's money you could afford to lose. That's true. Wow, check out this shot of the One World Trade Center. Really, really nice. Wayne McKay says not every follow-through day leads to a new bull market, but no new bull market has started without a follow-through day. You know, we did get a follow-through day, so to Wayne McKay's point, should you be risking 15% of equity on this follow-through day? No. No, a follow-through day is meant to probe the market. Now, is anybody familiar with Gerald Loeb's book, The Battle for Investment Survival? Now, Loeb is like, you're supposed to throw probes out into the market to test the waters. And as the market continues to rally, you should get sucked in and commit more capital to your idea, right? I'm not just gonna commit, 15% of equity on one follow-through day. But I think this follow-through day is warranted. Probably, you could commit maybe 1%, maybe 1 or 2% equity. Wow, look at this outdoor dining setup here. This is gorgeous. Hey, Flat Smack, what's up? So some insiders say the Fed is going to pivot sooner than expected. Maybe. Dan Zhang says, I feel like every time when the market goes down, Peter Schiff would say this is the start of something bigger. Yeah, I mean, I love Peter Schiff, don't get me wrong. But Peter Schiff is what you call a perma bear, I would say. And bears will never buy. These people will sit on the sidelines and sort of point the finger and say the bulls are wrong all the time. So I think it's important to be a little bit nimble, as Stanley Druckenmiller would say. Now, here's an interesting thing that Stan Druckenmiller says. Stan Druckenmiller says he never likes to do interviews and give his opinion on market direction. And the reason why he doesn't like to do that is because he says I could be bearish on an idea today and 150% long that same idea tomorrow. Now, granted, Stan Druckenmiller's, I would say, more of a trend follower. I would say same thing with, Paul Tudor Jones. And you could be very successful with trend following. So I am not committed to one specific bull or bear thesis. I'll react to the market environment. Yeah, Jeff says fun drinking game. Watch CNBC for an hour and drink a shot every time they say pivot. Yeah, I think we would all be hammered by the time that happens. Andre Almar, yeah, it's a bummer. WW says, do perma bulls exist? So I would actually borderline say I am a perma bull, but I always manage my risk. And I think that's just because I'm extremely optimistic in nature. I always think every idea I have is gonna be, oh, this is gonna be the best idea. I'm gonna make a fortune. But not to overuse the word pivot, Jeff. I'm always willing to pivot on my ideas if they don't work. I always know when to pull the ripcord. But look, historically, corporate profits in America generally go up over time, right? If anybody's read, Peter Lynch's book, One Up on Wall Street, if you just look at the data, historically, corporate profits in America tend to go up. That is factually correct. But corporate profits also go down from time to time. We have recessions. Recessions are normal. Recessions are normal. Hey, Marcelo Gill says, guys, smash the like button. Thank you, Marcelo. Appreciate it. Check out this view of One World Trade here. It's fantastic. Brandon Lewis says they are going to put Putin on a pedestal and praise him in the coming future. Yeah, let's sort of die down on the Putin talk and stuff because it attracts, a nonsensical. Everybody starts to fight in the chat. I'm just trying to chill. Dan Zhang says, Tom, did you watch today's match between Chelsea and Manchester United? I didn't. Who won? I'd be interested to see who won that. Dan, I slept in probably till a little bit after 12. A little bit after 12. So speaking of Fed presidents, let's see what Cleveland Fed President Loretta Mester had to say. Now, Cleveland Fed President Loretta Mester is historically very hawkish. He's usually a very, very hawkish Fed president. Oh, Dan, it was 1-1. Nice. Very nice. Now, Loretta Mester is in favor of a 75 basis point increase or rate hike at the Fed's next 2 meetings because she says, and I quote, "We can't let wishful thinking drive our policy decisions." Because as of now, Loretta Mester thinks that based upon the interest rate hikes that the Fed has already done, they haven't made any material progress on killing inflation. Now, I would actually give a little bit of pushback on that. Now, it may not be showing up in the CPI numbers. Now, there's 2 main CPI numbers that I think are appropriate for us to watch. And number 1, that is the headline CPI. And number 2 is the core CPI. Now, core CPI plays a little bit more credence, or the Federal Reserve puts a little bit more weighting or credence on the core CPI. And core CPI excludes very volatile food and energy prices. Now, where I think the Fed has succeeded is in demand destruction in the housing market. Okay, and that actually has shown up in data. And the data that shows that pretty clearly. We're coming up on Grand Street, by the way. Really nice view of the World Trade Center. Where that shows up is existing home sales data. So we heard from the National Association of Realtors on Thursday, and for the 6th consecutive month, existing home sales have fallen, and fallen quite rapidly, might I add. And that is directly due to higher interest rates. I mean, this time last year, A 30-year fixed rate mortgage was going for about 3.5%. Now it's going for 7%. Wow, Julia, that's crazy. That's insane.
Okay, that gotta be some fire shit.
Gary Carpenter, thank you so much. Yeah, I am getting better. You know, I'm feeling good. Feeling good, not gonna lie. Oh, everybody, you know what? All right, everybody, we got to do something a little bit out of the ordinary here. And I apologize for that. But we're going to have to end the live stream right now. But I'm just going to go live again, like in 2 seconds. I just got to do something. I completely forgot and I got to get this done. So I got to end the live stream, but then we could just jump right back on. I'm going to go live in like 5 minutes. But my phone sent me a notification. I was supposed to send out this email and I didn't send it out, and I got to send it out. So, all right, everybody, I'll see you in 5 minutes. I'll see you in 5 minutes. All right, take it easy.